On December 11, 2025, the global financial system was jolted in a way few had anticipated. This time, it wasn't a political crisis or a natural disaster that sent shockwaves through the markets, but something far more unexpected: Oracle's disappointing earnings report. Oracle, long considered a titan in corporate software and a major player in the AI revolution, missed Wall Street's expectations by a significant margin. The news reverberated instantly, sending shockwaves from Tokyo to New York, and exposing just how tightly interconnected today's global markets have become. Investors and analysts alike scrambled to make sense of the sudden downturn. The timing of Oracle's stumble was uncanny. Just as the disappointing news broke, the U.S. Federal Reserve had announced a major interest rate cut, hoping to inject optimism and stability into the markets. Instead, the two events collided, creating a dramatic tug-of-war between tech sector pessimism and central bank optimism. Investors watched in disbelief as Oracle's stock plunged in after-hours trading, dragging down major indices and setting a nervous, uncertain tone for the global trading day ahead. The ripple effect was immediate, with other tech stocks also feeling the pressure. This was a textbook case of market contagion, one company's stumble sparking fears across entire sectors. The domino effect was clear, as investors began to question the stability of other tech giants. The real question on everyone's mind: if Oracle, with its deep pockets and history of innovation, is struggling with AI investments, what does that mean for the rest of the tech world? Could this be a warning sign for the entire industry? The shock wasn't just about Oracle's numbers, it was about a potential crack in the AI narrative that's fueled the market for months. Suddenly, the future of tech-driven growth seemed less certain, and the world was watching closely for what would happen next.
Oracle's latest financial outlook delivered a double blow to Wall Street. Both profits and revenues are now expected to miss forecasts, sending shockwaves through the market and raising serious questions about the tech sector's near-term future. On top of that, Oracle revealed that its AI infrastructure costs are climbing much higher than anyone anticipated, putting additional pressure on margins and profitability. This announcement directly challenged the market's widespread belief that investments in artificial intelligence would quickly pay off and start generating big returns almost overnight. For months, investors have been chasing any company tied to AI, pouring money into the sector and assuming rapid, easy returns were just around the corner. But Oracle's report was the first major sign that the road to AI profits is much longer and far costlier than many had hoped or predicted. The impact was immediate. Oracle's shares plunged over 11% in after-hours trading, and the negativity spread quickly, with S&P 500 and Nasdaq 100 futures both dropping sharply in response. As a key cloud and database provider, Oracle's struggles sent a warning signal across the entire tech sector, highlighting broader risks for other companies betting big on AI. The market was forced to reckon with a new reality. Building the AI-powered future is a massive, expensive, and time-consuming undertaking, not a quick win. Investors suddenly realized that the journey to AI riches is winding, unpredictable, and filled with unexpected obstacles, not the straightforward path they imagined. Oracle's warning served as a wake-up call, reminding everyone that the hype around AI doesn't erase the hard work, the technical challenges, and the high costs required to make these ambitious visions a reality.
As anxiety swept through the tech sector, the U.S. Federal Reserve stepped in with a crucial lifeline: a 25 basis point interest rate cut. This move lowered borrowing costs for businesses and consumers alike, sending a clear signal that the central bank was ready to support the economy. The decision sparked a wave of economic optimism, as lower rates often encourage investment, spending, and risk-taking, all of which are vital during uncertain times. Fed Chair Jerome Powell took center stage to reassure markets, stating, "I don't think a rate hike is anyone's base case," effectively ruling out future increases for now. His calm and measured tone helped soothe investor nerves, making it clear that the Fed was focused on stability and growth. In addition to the rate cut, the Fed announced it would begin purchasing short-term Treasury bills. This action injected much-needed liquidity into the financial system, ensuring that banks and businesses could access cash easily, and that financial operations would remain smooth, even in turbulent times. This dovish stance was exactly what investors had been hoping for, providing a strong counterweight to Oracle's negativity and restoring some confidence to the markets. The combination of a timely rate cut, supportive commentary from Powell, and new liquidity measures worked together to steady nerves and lift overall market sentiment, reminding everyone of the Fed's powerful influence. Wall Street responded with an initial rally on the Fed's news, a clear demonstration that central bank policy still wields immense power over market direction, especially in moments of uncertainty. Even as Oracle's shock loomed large, the Fed's decisive actions provided crucial support, helping to stabilize the broader market and restore a sense of hope. The day became a dramatic tug-of-war between corporate disappointment and macroeconomic reassurance, with investors weighing the risks and rewards in real time. It was a vivid reminder that, even when tech giants stumble, central banks can still move markets and shape the economic narrative, offering a powerful counterbalance to fear.
Wall Street's trading day was a tale of two halves. Early optimism from the Fed's rate cut, then a sharp reversal as Oracle's bad news hit. The S&P 500 closed up 0.7% before Oracle's report, but after-hours trading turned red as tech sector anxiety spread. Oracle's plunge triggered a domino effect, erasing the Fed-fueled gains and setting up a volatile next session. This whiplash showed how quickly sentiment can shift from macroeconomic hope to microeconomic fear. Even the most supportive monetary policy can't shield markets from disappointing corporate results. Investors were reminded not to get complacent. One company's stumble can upend the entire market mood. The focus shifted from celebrating the Fed to questioning the foundation of the tech rally. Was the AI boom built on hype or substance? Oracle's report forced everyone to reconsider.
As Wall Street's day ended, Asia woke up to Oracle's shock, and the negativity spread fast. Japan's Nikkei fell 1%, led by AI-related stocks, while SoftBank, Oracle's partner in the Stargate project, plunged 7.5%. The news cast doubt on ambitious AI ventures and showed how interconnected global tech has become. Hong Kong's Hang Seng barely held steady, but the broader MSCI Asia-Pacific Index dropped 0.5%, confirming widespread anxiety. Risk-sensitive currencies like the Australian and New Zealand dollars slipped as investors sought safer havens. The Asian session set a cautious tone for global markets, proving Oracle's warning was a sector-wide concern.
While stocks swung wildly, the bond market stayed calm, buoyed by the Fed's rate cut and dovish signals. Lower rates make existing bonds more valuable, so investors rushed to buy U.S. Treasuries, pushing prices up and yields down. The 10-year Treasury yield fell to 4.13%, while the 2-year dropped to 3.52%, reflecting confidence that rates would stay low. Bond investors focused on the big picture, a supportive Fed, not Oracle's corporate woes. This stability in bonds provided a crucial anchor amid stock market volatility. The financial system wasn't panicking, it was adjusting to a new reality of lower borrowing costs and a tougher path to AI profits. The bond market's calm suggested resilience, even as equities reeled. In currency markets, the Fed's rate cut sent the US dollar lower, making it less attractive to global investors. The euro surged to a 2-month high, boosted by both dollar weakness and upbeat signals from the European Central Bank. Some analysts predicted the euro could climb even higher as the year ends. The Japanese yen also strengthened, as expectations grew that the Bank of Japan might finally raise rates. Diverging central bank policies made the yen and euro more appealing than the dollar. Meanwhile, Risk-sensitive currencies like the Australian and New Zealand dollars slipped, reflecting global caution. The currency market became a complex dance of central bank moves and shifting risk appetites.
Commodities, especially oil, followed their own script, largely separate from tech and central bank drama. Oil prices dipped slightly after a recent jump, with Brent crude at $62.15 and US crude at $50.44 a barrel. The earlier price spike was driven by US seizure of a sanctioned tanker off Venezuela, raising supply concerns. But worries about slowing economic growth kept prices in check. Less demand means less need for oil. The market balanced fears of supply shocks against fears of weaker demand, keeping prices volatile but contained. Unlike stocks and bonds, oil's moves were about barrels, not balance sheets or interest rates. It was a reminder. Each market has its own drivers, even in a globalized economy.
With Oracle's shock and the Fed's move digested, attention turned to the next big test, the U.S. jobs report. The November non-farm payrolls, due December 16th, will reveal whether the economy is still adding jobs and raising wages. A strong report could calm nerves, suggesting consumers will keep spending and markets might recover. A weak report, however, would validate slowdown fears and likely trigger more selling. The jobs data will show if the Fed's rate cut was precaution or necessity. Until then, markets will stay on edge, parsing every headline for clues. The tension between tech's challenges and the broader economy's resilience will dominate. For now, the world waits. Uncertainty is the only certainty in financial markets.